Are you a business owner looking for ways to help reduce the amount of tax you're going to have to write to the IRS? Well, if so, I'm going to walk through a business tax credit that you might be able to use this year to help reduce your tax liability. If you have any questions, leave them in the comments below and I'll get back to them as soon as possible. And then I'm going to create a separate video along the same topic, but it's a different tax credit that your business might also be able to use as well. So enjoy the video. Thanks again for watching.
All right, so in this first video here, I'm going to talk about a tax credit that's available to business owners here. And the focus is on retirement plans and the startup costs associated with opening up these retirement plans. Again, this is tax credits. So let's dive into the difference between a tax credit and a tax deduction. So just say your business does $1 million in revenue and you have expenses, cost of goods sold of $950,000, and just say all these expenses count as deductions. Okay. So you got $1 million of revenue, you got $950,000 of deductions. So your net income is $50,000. Net income is the driver of what your tax liability is going to be. So in this example, your tax liability is $10,500, and that's based off of this $50,000. Okay. So you got your deductions here, and now you got this income tax liability of $10,500 that you got to write a check to the IRS. Now, all of a sudden, you come across this tax credit, and the tax credit you come across is worth $5,000. So you get to claim the credit, right? And what a credit does is it reduces your tax liability. Okay. First, a deduction reduces your net income to come up with the amount of tax that you owe. This takes it one step further. Now you know what your tax is, what's due, what's owed, right? But then you got this credit and that further reduces it. So instead of writing a check to the IRS of $10,500, a tax credit now reduces that check that you owe to the IRS by $5,000 or whatever that credit is, whether it's $100, $5,000, $10,000, whatever that is. So now your tax due in this example is $5,500. So whenever you see tax credits, you should always be on alert because they're a lot more advantageous to you than a tax deduction. Tax deductions aren't bad either because it helps reduce your net income, which drives your tax liability calculation. But a tax credit's a lot better. So now that we know what the difference between a tax credit and a tax deduction is, let's dive into this tax credit. So this tax credit are startup costs that are associated with a business that's setting up a retirement plan for the first time. So eligible employers, right? So eligible companies. You have to have 100 people or less who have received $5,000 in compensation by you in the preceding year. Okay. So you got to meet these three criteria here. You have at least one plan participant who is not a highly compensated employee. I'm going to go through this on the next slide, what that means. And then 3 years before eligibility, your employees weren't substantially the same employees who receive contributions or benefits in another plan sponsored by you. So if you had some other 401k plan or some other retirement plan that these employees were part of that you were, that you had in your company that you were giving benefits to, you aren't eligible for the startup costs. Tax credit. So that's part one, eligible employers. So highly compensated employees, what does that mean? So if you own more than 5% of the interest in the business at any time during the year or preceding year, right, that means you're a highly compensated employee. Or for the preceding year, receive compensation from the business of more than $135,000 if it was 2022, or $150,000 it was 2023, and it was in the top 20% of employees when ranked by compensation. So this is what defines a highly compensated employee. So going back to that prior slide, you need to have at least one plan participant who is not a highly compensated employee. And on I think the last slides in this presentation, I'm going to get to how this is going to, unfortunately, certain retirement plans will not be part of this startup cost tax credit. So part two of what you need to, follow is the amount of the tax credit here. So the credit is 50% of your eligible startup costs up to the greater of $500, okay, or the lesser of $250 multiplied by the number of non-highly compensated employees who are eligible to participate, or $5,000. So what that means is the most of this credit is essentially $5,000. That's the max of this credit. Because if you have if you have just 10 employees that are non-highly compensated, 10 employees times $250, that's $2,500. That's your credit right there. If you have 20 employees, that's $5,000. If you have 21 employees, now you're in excess of the $5,000. So again, long story short, the most that you can get in this entire tax credit is $5,000. Okay. Now the credit is eligible to 50% of your eligible startup costs. So that applies to companies that have 51 to 100 employees. If you have 50 or fewer employees, you can claim the credit for 100% of the costs, right? To kind of, startup costs of, setting up this retirement plan. But again, all the companies here, whether you have 50 employees, 75 employees, you can just take $500 as your startup credit. Or you kind of look at cause it's the greater of $500 or the lesser of, 250 multiplied by the number of highly compensated employees, non-highly compensated employees are $5,000. So, I think the minimum of this credit's $500, and the max is $5,000. So the next one, eligible startup costs. So this is setup costs, administering the plan, educating your employees about the plan. So, there's a lot of, a lot of these plans, depending on who you're using to kind of, set up the retirement plan, some, it could be $1,500 startup costs. It could be $2,500 startup costs. It really depends on, what it costs to kind of administer the plan, but that's eligible startup costs. It's kind of setting up and administering the plan. It's not, the cost per individual. It's just, a lot of these, retirement companies, they have this, here's your cost to kind of get this thing started. And that's what's part of this. Plus, the time and cost to educate your employees about the plan, right? There's a cost associated with that as well. Number 4, eligible tax years. So you can claim the credit for the first 3 years of the plan. Okay. So let's go back to, these costs here. So first 3 years of the plan. So you can do 500 the first year. You can do 500 the second year. You can do 500 the third year. So it's just not 500 the first year. It's the first 3 years of the plan. And then companies can either choose starting to claim the credit in the spelling error right here is in the tax year before the year which the plan becomes effective. So the plan becomes effective in January 2024 and you set everything up in 2023, even though it becomes effective in 2024, you could still start the credit in 2023. No deductions allowed. Companies can't deduct the startup costs and claim the credit. So let's go back to the difference between a credit and deduction. So just say in your expenses here, you're recording $3,000 of startup costs, right? And that's part of your expenses. That's a deduction that you're claiming here. You can't do this and then also get the credit of $3,000, right? You have to choose one or the other. And you don't have to claim the credit. So that's also nice. Let's see here. And then next up, the tax form. So in order to claim this credit, you got to complete this tax form, and it's 8881. It's called the credit for small employer pension startup costs. And then the last slide here, if you're a solo person, right, you got one company, you got one plan, and you're the only employee, by default, you're kind of like the highly compensated employee, which means you don't have any non-highly compensated employees, so you're not eligible if you got a solo 401k plan. So if it costs you $2,500 to set this solo 401k plan up, you're not eligible. And companies can't cancel an existing plan and set up a new one just to kind of get this credit. So remember earlier, if you're already administering a plan or, some type of benefit or retirement plan for your employees, you're not eligible for the startup costs. So this is really for companies that don't have an existing plan and they need to start getting one set up. There's a startup cost tax credit, and that's what this presentation is. So again, if you have any questions, let me know. Leave them in the comments below. Thanks again for watching.